Welcome back. My name's Chris Gosselin from Australian Fund Monitors. And today we're catching up with Simone Haslinger, the CEO of East Coast Capital Management, or ECCM. ECCM's trend-following managed futures fund delivered over 9% in January, taking their annualised return over the past 6 years since inception to almost 15%. Simone, welcome.
Thanks, Chris. Pleasure to be here.
Nice to see you again. Your fund now has a Sharpe ratio of 1.11 and a correlation of just 0.26 to the ASX 200. This clearly demonstrates its diversification credentials. If it's possible to do so in a single sentence, how would you describe your fund and the strategy?
So we run a systematic global trend following strategy that trades liquid futures markets across diverse asset classes, and we look for persistent price trends. So we maintain strong diversification and disciplined risk control.
So the model trades over 80 global futures markets. So looking at January and that really strong result, where did the strongest signals or returns come from?
So January was really remarkable because of the breadth of those signals. We saw strong trends continue across a number of different asset classes. Firstly, in the commodity space, metals were very strong performers across gold, silver, copper, these sorts of instruments. We've had trades in these sorts of exposures for some time. January, we really saw a strong acceleration of those existing trends, albeit very big corrections in the last couple of trading sessions at the end of January. In the energy space, we saw crude finally break out and energies hold some momentum. And then we saw some really strong thematics in terms of US dollar weakness. So, sustained moves across the Aussie dollar, the sterling, the euro, and others. And then in equity markets, certain less well-held equity indices from an Australian lens standpoint performed very, very strongly through the month of January, with markets like the Kospi in South Korea and the Taiwanese index performing as some of the top performing markets in the month of January. So it was really the breadth of those trends across numerous asset classes that contributed to such a strong result for us in January.
So almost a perfect storm, or the opposite of a perfect storm.
Yeah, that's right. It was a really strong month for us across a number of different fronts. And I think it goes to show the value of diversification, as you said.
So Simone, your fund's had 63% positive months historically. So how do you avoid overtrading in choppy conditions?
We are really looking to capture sustained moves in the market. And so our systems are calibrated to separate noise from those genuine trend signals. Our signals give trades room to breathe, to really capture these directional moves, directional momentum, but not every wobble in the market. And so by doing that, we can avoid that death by 1,000 cuts kind of trading.
So you're not looking for short-term trades necessarily. You're looking for that longer-term trend.
Yes, that's exactly right. So, we recognize that not every trend signal will in fact develop into a wonderful, sustained long-term trend. And so we have stop-loss positions in place with every trade that allows us to know how much our downside is and how much risk we're taking. But we do set those levels at levels that mean we're not chopping in and out of trades constantly, because ultimately it results in overtrading and frustration and isn't, as I say, giving those trades room to breathe.
Sticking to the risk and diversification themes, what environments tend to challenge the strategy the most?
So it's really that whipsaw or extreme choppiness that is the difficult market environment for trend following strategies generally. And so it's when you're seeing those very sharp and large directional moves, the sorts of moves that can be triggered by sudden policy change, for example, the so-called Liberation Day events earlier of 2025. Those are the sorts of conditions that make trend following quite difficult and can be challenging. But ultimately, our systems are designed to try to manage through those conditions. And really, the way that we do that is through small individual position sizes and very broad diversifications we've touched on embedded in the portfolio composition.
So if trends do reverse sharply in commodities, how quickly does the model adjust?
So it does adjust fairly rapidly. We are continuously monitoring prices. We know the amount of risk we're taking at any point in time. And if the market pulls back to those levels, we will exit those positions dispassionately. Ultimately, what's great about the trend following style is that it's entirely systematic. There is no emotional bias. There's no desire to kind of hold on to a trade for too long. If the trend does reverse rapidly, we will exit rapidly at those levels and sit and wait for other trends to emerge.
Simone, almost 15% per annum over 6 years speaks for itself. But if you had a minute to describe why you should allocate to a systematic trend now, what would you say?
So I think that at this point in the market where there is so much uncertainty on the horizon, significant policy risks still hanging over the world, geopolitical concerns, inherent risk around market regime change, looking to how you can diversify your portfolio and strengthen your portfolio to have resilience beyond traditional assets. This style is very well recognized for performing well in times of crisis in traditional asset markets. So considering just broadening and diversifying your exposures across your portfolio in the context of what's happening in global markets today, making sure that you've got exposures to these sorts of exotic underlying instruments that most people don't have access to could really be the differentiator for your portfolio over time.
I think it's a really important point, Simone, because equities have been so strong for a number of years now. Investors tend to get swayed by that, and they're chasing those sort of very attractive but not always long-term realistic returns. So maybe diversification is the name of the game, and now is the time to diversify.
Yeah, look, I think a lot of the commentary in the last couple of years has been around what will be the portfolio insulation. Historically, people have looked at bonds to insulate equity exposures, and in the last few years, we've actually seen stocks and bonds move together. So those traditional correlations have broken down. What's unique about this style is that we have no preconceived notions about how any particular asset classes should move with one another. We simply cast the net incredibly widely to look for as many uncorrelated markets as possible, but we don't presume that if we have equities, we should also have bonds to counteract. We simply say, where is the price action today? Where is the capital flowing? And we follow that. And so as market regimes change and as those correlations change, we don't have to make adjustments to the portfolio. The portfolio will gravitate to where the market is moving. That's what's really unique about this strategy and why I think trend following really stands the test of time.
Simone, thank you again for joining us. We always enjoy catching up with you and what's happening in the commodities and trend following world. Best of luck, and we'll look forward to seeing you again soon.
Thanks, Chris. Speak soon.